The next question we've got here is from Joseph. And Joseph's question here is, I've heard some people say I shouldn't look at anything less than a 5% yield. What yield should I target? And what are the pros and cons of high yield versus low yield? So thanks for sending that question through, Joseph. I guess there's a few things to unpack there, and yield is really quite an arbitrary number in terms of there are so many factors that go into rental yield. It's not just about the rental income you're receiving. It's about some of the other, I guess, factors that come into rental yield. So what I mean by that is, firstly, if you change your rental yield, you're potentially limiting your choice. So not only choice in terms of location. So you might go into a location, let's just use Far North Queensland as an example. You can get higher gross rental yields there, but if you peel back the layers and you look at some of the running costs, so running costs being council rates and insurances in particular, and even property management fees in that location, you will find them to be more expensive than other parts of the country as well. So that will, you peel that back, is that same yield equal to maybe a yield in New South Wales or Victoria? Potentially not when you strip the costs back. Also, it can also limit your choice in terms of the actual fit out of your home, right? So you might have a property that has been, had a recently renovated kitchen and bathroom, which we saw one of the properties we went through before was at 4.9%. Well, that extra 0.1%, depending on the price of the property, might anywhere be as low as $8 a week to maybe $13, $14 a week for every 0.1% of a decimal place. If you're sitting there going, well, hang on, I'm only going to look for 5, but then I bought some place that's got a heavily outdated kitchen and bathroom, maybe it needs a lick of paint, and you're kind of ticking off all these things and going, well, hang on, once I've factored all this in, I'm going to be out of pocket maybe 50 to 60 grand in 5 years' time when it comes time to actually do this work. Or I could buy this property right now that's at a 4.5% yield, which we know is maybe $50 a week less in terms of rent, but I've got an asset that's got a renovated kitchen and bathroom. I'm going to have a set and forget type of property. And, in terms of as time goes on, there might be other factors to take into consideration. So you might be thinking, like, is your rent going to be the same in year 1 as it's going to be in year 3? I mean, we're kind of seeing over the last few years, it's been double-digit rental growth. But even if you're getting an extra 5% per annum, your rent's going to increase. We're in an environment at the moment where interest rates are likely to come down. So, if you've got a $500,000, loan on your property, that's a couple of grand or a grand and a half shaved off your actual repayments there each month, each year, I should say, as well. And then the other thing is, as well, is like day 1 is going to be your most expensive time of holding the property, or year 1, I should probably say. So, from a cash flow perspective, and this is just an example, we bought a $500,000 property, but we purchased it with full debt because one of my, not bugbears, but I think where people aren't aware of when it comes to buying property with equity, equity is still a loan that needs to be serviced once you've taken equity out of a home or out of an investment property, right? So we bought a $500,000 property, but our buying costs for stamp duty, etc., have all come through that equity extraction. So we've actually taken on 525 debt. We've got our rent coming through, we've got our repayments, we've got our outgoings. But in year 1, it's at 18,900. And in this scenario here, this isn't really factoring in rate cuts. This is just that, is historically speaking, your rents typically outpace your outgoings just a little bit each year. So once you get to year 5, your cost of holding that property is even less. So I guess if you can just keep in mind, if year 1's going to be the worst year, assuming, again, to factor in where you're sitting from a rates perspective, if we're going back to, say, 2020 and we've got a 1.99% fixed interest rate, well, that's when we probably need to have a little bit of awareness and going, hey, we're basically at a cash rate of 0. There's only one way from here from rates, we're probably going up. So just having that a bit of acute awareness, but in general, for keeping long-term averages of rates for about that early 5 number, you're likely to see that you're holding costs on that property is likely to go down as time goes on. So it's something to take into consideration. I think for most people, the biggest thing for them is going to be that, again, it's the type of property that they're holding. It's that comfort in terms of maintenance, outgoings, etc. They're the things that are kind of bugbears for people as they go along. So sometimes you have to sacrifice yield to get the type of property you want from a presentation standpoint as well. But then beauty's in the eye of the beholder. Some people like those older and tired properties because you can use that as a value add as well. So I'd say to your question earlier, the yield component flexibility is key. Because it's going to open up more options and it's going to give you, in terms of location, but also in terms of the types of property as well. And to give you a bit of a pricing guide as an example as well, if you are to turn around and go, well, I only want a property with a 5% rental yield. Well, as we work our way through this list here, we can see even WA Metro, you're going to be excluding yourself from a lot of locations. Not only do you have to look at the price to get into that market, you also need to look at the yield. Queensland Metro basically doesn't exist if you're talking about a 3 or 4 bedroom freestanding homes. These metrics here are solely for 3 or 4 bedroom freestanding homes. So you can see here, we've eliminated a lot of opportunities for ourselves if we go straight to a 5. We're basically keeping in some options in regional Tasmania, regional Queensland's there, maybe at the very, very limited opportunity in WA Metro, definitely not happening in Vic Capital, and some Vic regionals that's in there as well. So again, it's, what's more important for you? Is it the location? Is it the fit out of the property? They're the things that you need to weigh up when it comes to mine. But thanks for flicking that question through as well.